Time now to get an update from one of our regular guests here on IGTV. It's Serge Berger from thesteadytrader.com. Before we get to him, just to quickly update you on where IG sees the markets at the moment. Of course, we went into the weekend with that jobs report that we saw, which was stronger than had been expected. And at that point, we were expecting to see yields rise and the bond equity markets pull back. And in fact, the inverse happened. But then, of course, the weekend, all this was completely overcome by the developments, so geopolitical developments that came across us the weekend. The weekend markets were down, expecting a lower start to this trading week. But in fact, that didn't happen. But where we've seen some of the biggest moves has been the oil and gold markets. Let's catch up now with Serge and work out what's happening. Serge, thanks indeed for your time. I know we're catching up with you very early in Palm Beach at the moment, so thanks indeed for joining us. Just wanted to quickly get your thoughts, first of all, on how you feel about the markets as a trader and where you see the big moves beginning to develop. I mentioned gold and oil because that's where we've seen some of the biggest moves out of this weekend turmoil. But your thoughts, first of all, on what's happening in the markets.
Hi, Jeremy. Yeah, so I think, we're still at this point where we've got essentially two forces that are kind of fighting each other. For one, we have the economic cycle, which is continuing. I think we're a very late cycle. So you've got that now really kicking in hard. Here in the United States, there is essentially a lot of headwinds from higher interest rates now that are finally kicking in a year and a half later. So that's typically kind of how the cycle works, year and a half, even sometimes 2 years later. That's really starting to bite, and you can see that everywhere and feel it, quite frankly. That's number one. The other thing is things like some of these student loan repayment programs. They have now kicked in last week. And I know that especially for non-US persons, that's something that's sometimes been hard to understand, but the US individual has a lot of school debt, like ridiculous large amounts. So anyway, aside from all that, the economy is slowing. So at the same time, though, you have these fourth quarter tailwinds that can work from a trading perspective. And that's a very natural reaction of, what I call mutual fund or just fund underperformance anxiety into year end, where they have to catch up because they're underperforming their benchmarks. So you've got these two opposing forces working. However, I see a lot of people very complacent on the latter matter, which is the fourth quarter tailwinds, typically, again, the seasonal strength, but giving little sort of credence to the former, which is the economic headwinds. So I ultimately think this is going to be a choppy going, and we could be one surprisingly bad economic data point away from equities really taking it on the chin, bond yields coming down hard, and that basically means everything else will move, including oil and gold and some of the other things.
Well, let's pick up on the gold move first of all. We saw this move up out of the weekend. People obviously looking for some sort of stability, some sort of safety. What are your thoughts on the technicals around where we are for gold at the moment?
Yeah, so broadly speaking, gold essentially has done more or less nothing, frustratingly, for the gold bugs since essentially COVID, right at the beginning of COVID. In fact, let's call this summer of 2020. So that's a long time to get a chop back and forth. However, the longer term trends remain bullishly intact, and for anyone that's ever looked at a chart, you can kind of see that doesn't change. However, in the more near term, what we've seen is gold has been a clear function of real interest rates going higher. So that's the nominal rate of interest minus the actual inflation rate. As interest rates have gone higher and CPI or inflation data in the US has come in, real rates have gone up. So that is why, if I go to the daily chart of gold, we've seen a pretty sharp sell-off basically since interest rates started accelerating higher in the spring. However, and this is just what we said before, if we were to get into a point now where economic data starts to really clearly cool down, and I do think that is likely going to happen, not necessarily this week, but I think over the course of the fourth quarter, then gold could start to get a serious bid again, because real interest rates will be coming down. So they've gone up, they would be coming down. So that could get gold. In this case, we're looking at gold futures. It's really not that hard to imagine going back to where we were a few weeks ago, which is essentially just shy of 2000. So those moves can happen very, very quickly equally so both in the interest rate market as well, which is basically what this relates to.
And then, so what's all this mean then for oil? We know fundamentally that if there's instability in the Middle East, this does tend to disrupt the supplies from some areas. And of course, we've also got the geopolitics that's bubbling under between Saudi Arabia, Iran. We've got here two sides that are constantly at each other's borders, and Israel amassing troops once again in Gaza. And this all goes to give us some sort of question mark over supplies. But technically, what about the price of oil?
Yeah. So with the price of oil, there's essentially three forces that it's a complex one, oil is, because you've got the supply story, which is what you were referring to there, the geopolitical stuff. Then you've got the demand, which should be, all else being equal, slowing down because of the what's mentioned about the economy slowing. But then you've got the dollar as well. So oil still is denominated in dollars for the time being, for the most part. So what happens if the dollar were to start to weaken, which would be a function of interest rates coming off, as I said before, then oil has a much easier time to catch a bid. So if the currency that the asset denominated goes down, then the price has to go up just to stay at the same level. Again, that's just one part, though. We still have to take into consideration the demand. So to me, honestly, I think oil is probably kind of range bound, to sound really boring about it. I'm not quite sure it has the ability to get much above 95 on Brent. I'm also not quite sure it really can break much below 80. So you've got that range. Right now, we're somewhere right in the middle. But also consider oil as a read for inflation and what that means for the equity market, which I know we'll talk about later. I think there's a lot of read because people have gotten spooked about oil prices going higher. That's been where you saw equities come under pressure, but oil then has come off again over the past 2 weeks, which has made it a bit easier for equities to get a bit of a bid. So it's a tricky one, but again, I would say the range is 80 to 95 on Brent.
Okay, let's pick up on that point about the equity markets then, because you said at the top you felt that there was possibly an opportunity here to take out some sort of a benefit from a short position, and that you were worried about the longer term prospects of the markets. Against what index would you be looking for a trade to develop, and perhaps maybe the canary in the coal mine that might help us sort of understand other markets?
Yeah, so I think it's always easiest in this case to look at the S&P 500, which is for most sort of hedge funds and family offices that I talk to is really kind of where they benchmark against in terms of their broader risk allocations. So when you look at the S&P, we just have to keep in mind that it's not as it seems. And I think you and I have talked about this before. It's essentially a story of those what we now call the Magnificent Seven. It's a large part and the top 10 stocks in the S&P 500 make up about 30% of market cap. Historically speaking, it's closer to 20%. So that's still a long way from where it can be. To me, the S&P is important to watch. Again, I think it's a matter of now seeing how the Microsofts, the Apples, the Nvidias of the world, how they react to higher rates here going forward. So, I think the S&P here, for the time being, probably has a hard time getting much above 4,400, so that's 4,400. On the downside, if you break below 4,200-ish, it probably opens up the door towards about 4,000 pretty quickly. So I think against these levels where we are right now, so against 4,400 and change, or again, just give or take 50 points there, that's to me a pretty good reward to risk on the downside, keeping in mind that we have a lot of economic data. And just not a lot of news flow here at the time being.
What about an index here in the European markets? Have you got anything that you could demonstrate which might give us an understanding about whether or not there's any divergence or from against the US markets, or anything that tells what's happening on this side of the Atlantic?
For sure. I mean, I would really look at the DAX, right? So when you look at the DAX, you see, again, let's start with where it all comes from. You have to look at the economy, you look at economic data and gravity, and Germany essentially, the mood from a business perspective, but also with the individual consumer is unfortunately just terrible and not really improving. We've seen the economy going in and out of technical recession all year. And then, of course, you look at the chart. And if you look at the chart here, you can see similarities to where we were in 2022, early 22. That's to the left of the on the left part of the chart, and we're kind of repeating something very similar here, except we're doing it at a level that's maybe even a bit more precarious. If you like to keep it simple and kind of draw lines on a chart, which I always warn, there's more to it than that, but notice the overhead resistance of all the moving averages: 200-day, 100-day, 150. So those are all overhead resistance up against simple horizontal resistance around 15,000, 600 or so. So very much like the S&P against 14,400 or whatever we said before. I would argue that that's the level to lean short against for at least a retest for now of about 14,950 or so is where we were just a few days ago. And if that gives you probably around looking at 4,500 pretty quickly.
Yeah. Also, wanted to pick up on the point you made about some of these tech stocks as well. Anything in particular you want to highlight? Because tech stocks, they did enormous amounts of upside business. And in fact, it was techs that was this very narrow range of breadth, if you like, in the markets. It was techs that really did all the heavy lifting on the upside. How do you feel about them now with the potential for downside in some of these equity markets?
Yeah. So the potential for downside on plenty of them is pretty bad, pretty sizable. I would, however, and I think everyone kind of can get their head around that. That's always, kind of the easier part is to be a disbeliever. On the other side, though, and this is where I would look at longs, is you look at something like Meta. So this is formerly Facebook, and not only is the absolute strength here notable. I mean, this thing can't go lower, or seemingly not lower. Earnings coming up later on this month, so. Be aware of that. But at the end of the day, this is a stock that has not had, hardly any sell-off. You can look at it also from a sector perspective. So Meta essentially represents the communications sector in the S&P 500. Here too, there's very little, weakness. In fact, it's holding in, almost spookily well. So I would look at something like Meta to maybe offset some shorts. Again, this does not represent all the stocks in the tech sector, but one name that particularly just stands out and shows a lot of relative strength.
Yeah. Okay. All right, Serge, we'll leave it there. But thanks for joining us with this quick tour around some of the charts you're following. And indeed, thanks for joining us from across the water. That's Serge Berger from thesteadytrader.com.